morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Indian equities are set for a slower start today after hitting record highs on Monday. If Nifty signals a flat to positive start coming in for the Wall Street, US markets clocked yet another positive session ahead of the inflation data and the Asian shares fell on fragile China sentiments. FII purchased equities to an extent of 1,473 crore and DIIs. They have bought equities to an extent of 366 crore. In terms of FNOQs that we have, FIIs, they've been net buyers in index futures and they've been actually buyers across the index futures, stock futures. Where they've been selling out perhaps is the index options and bank Nifty options. That's where they're the sellers. In terms of what we have in FNO ban, new in ban, BHEL still remains in the bank. India Bull Housing Finance, Delta Corp, Hindustan Copper, India Cements, Manappuram Sale, PNB and Chambal Fertilizer. What comes out of the ban is Balrampur Chini, but we are going to be discussing in the trade setup strategy of the day and FNO updates in just a bit. But first, let's actually talk about the milestone with Nifty being at that record 20,000 level. Indian equity markets ended at a record high level with Nifty crossing 20,000 mark for the first time in the previous session. The upward momentum in the markets, if you see, started after March 2023 with the dawn of the new financial year. After falling to a low of 16,950 level, the Nifty began its up move, gaining close to 18% since then. Of the 50 stocks on the Nifty 50 index, 49, if you see from March, have participated in this rally, with Adani Enterprises, Tata Motors, Adani Ports, NTPC and Cipla taking the top 5 spots. The only place or the only stock which perhaps ended or did not see much of the participation being the only one in red was UPL. On the other hand, analyst darling banks, HDFC Bank, ICICI Bank and State Bank of India underperformed Nifty 50. Albeit the stocks are in the green. A closer look to the data, if you see on the screen flashing right in front of you, shows that automobile stocks have led the rally, with passenger vehicle as well as two-wheel segments outperforming the benchmarks. In fact, the Nifty Auto Index has also managed to outperform the Nifty 50 by 33 percentage points in FY23. Now, also, let's talk about the earning potential. What's beyond 20,000 level is the question that most of you will ask. Well, superior growth is expected to continue for FY24 as well, followed by the same moderation in growth in FY25, according to consensus analyst estimates available with Bloomberg. The analysts expect Nifty earning to grow at a compounded annual growth rate of 18%. Now, the data shows that the analysts believe there will be some change of guards at who drives the earning growth here on. But metal stocks are expected to spearhead earning momentum from the Nifty thanks to the declining cost. Oil and gas are also expected to follow in suit. But look at the companies that we have with the highest growth EPS potential. But let's get going and talk about the market trade setup. Exuberance, time to book profit or not? And to take the discussion forward, we have a special guest with us today, Sushil Kedia, founder and CEO of Kedianomics. Morning there, and thank you so much for taking out the time and joining us.
Morning.
All right, time to book profits, or you think the exuberance will continue?
Indices are different, stocks are different, and various sectors will do different things. So there's no one thing that will fit across the board over the whole market.
Where's the froth coming? Where is more froth? Perhaps in the small cap, broader index as compared to large caps? And what would you suggest to our traders out there, who's going to be looking at Nifty and Bank Nifty perhaps? What's the strategy that you'd suggest?
See, there are various time frames on which various actions are feasible. The one that we typically focus on is, at least a swing trade of 8 to 10 days. So we will continue to bet bullish on Reliance, HPCL, BPCL, IOC for the time being. Chennai Petro has run up a lot. So any fresh entries in this very volatile up move have to be calibrated. But, standalone refineries and all the oil and marketing gas stocks, Reliance falls within that. And then, defensive like a Hindustan Lever or a Tata Consumer is what we are betting on. I'm going to be remaining very, very aloof from the large ITs, particularly Infosys, Coforge, where a huge amount, the promoter sold out. So the charts of Infosys, Coforge are ready. Whenever the market correction will set in, these are the major IT stocks that are the first ones we'll go and short sell. We are going to stay aloof from extremely overbought auto names. Most of the large banks are again precariously poised. There's only last mile froth left in them, no sustainable pattern to get in here and then make any sustainable gains. So banks, autos, IT is what will refrain from. Chemicals, oil and gas, and to some extent, select NBFCs like a Cholamandalam is what there is a trading momentum in. That's for the large caps. But there is a lot of cream and juice in, select mid caps that we've been very strongly backing. So a stock like Saregama, say, for example, the charts are poised for a major takeoff of another 70-80% up move. Or say an Indiabulls Realty that has come back from dungeons of misfortune and today is the cheapest in terms of market cap per acreage of real estate available to them in Bombay. It's the cheapest Bombay real estate company. Chart is excellently poised. So whether on momentum or whether on, a sense of revaluation, the laggard stocks is where we are going to be still long on and will remain very cautious with IT, large banks, and autos.
All right. What next for Nifty? I think that's the million-dollar question that most of the people across the street would want to ask. After scaling that 20,000 mark, like a batsman, takes a fresh card once he reaches that 100 mark. Do you also think the same strategy applies for Nifty? How are you looking at it?
I am missing the first part of your questions. Can you repeat that first sentence?
Sure. What's beyond for Nifty after 20,000 mark? Do you think you expect some sell-off or some profit booking perhaps to now take place? You think it's time to book profits? How are you looking at it? What is the trajectory?
Whenever these round numbers get crossed, everybody, with or without reason, gets into a euphoric celebratory mode. So if everybody is euphoric, how is trading happening in the market? Is a question all of us should ask. सब लोग तेजी में हैं, तो माल बेच कौन वरना सौदा होगा कैसे? So these euphoric behaviors is where corrections will come in. A few hundred points more after this 20,000 breakout, and a surprise correction may take it back to 700-800 points or even more. So I'm not going to ever allow markets or anything else to make me emotional.
That's a point well taken, Mr.
Inside the emotion of 20,000, my driver, panwala, barber, small investor, large investor, everybody is dancing. So if everybody is emotional, somebody is rational, and I like to be on that side. That's why the sectors that I've marked very cautiously, if a correction sets in, we'll go short on them, not on the others.
Hold on to that thought. Mr. Kedia, thank you so much for taking out the time and joining us this morning. It was indeed a pleasure chatting with you, but let's address the market open. 20,000 mark sitting way above that, 0.5% of gains coming in. 20,080 level. How pretty does it look on the screen right now? Look at the levels right now, but will the profit booking sink in right now? 700 to 800 perhaps is the correction expectation coming in from Mr. Sushil Kedia, but will that actually happen anytime soon in this week? Remains to be seen. Not a bear out here, but let's participate into the optimism out there. 20,000 about that mark, comfortably about that level, with gains of around 0.5%. Indeed, a win for Indian equity markets. It's been quite a journey, almost a 52-session journey from 19,000 mark to 20,000 level. That's the screen for you. Bank Nifty. Let's look at the screen. How does that stack up? And look at the participation perhaps which is coming in from Bank Nifty. We're looking at gains to an extent of 0.5% out there. 45,750 mark. Actually nearing now 45,800 level for Bank Nifty. It is indeed a second day of participation. The last week was a good one, perhaps after weeks of losses, perhaps that we've seen again coming in. Monday we saw the record rally, and today's session perhaps is just extension of that exuberance coming in for Indian equity markets. Let's look at small cap and the mid cap index, because that's exactly where most of the people anticipate the froth is coming in from. 0.3%. Gains coming in from the mid-cap index, and small-cap index is acting no different. Actually, it's a bit of outperformance coming in from the small-cap basket first, where look at the sectoral indices that we have on the chart. IT is faring up well, despite a bit of caution which has been coming in from most of the technical experts across the street for this one. Let's talk about the other sectoral indices that we have. Pharma, 0.4% out there registered even for pharma. Let's look at the other sectoral indices. FMCG is holding up for you. Right now, it looks like a flat to positive start, but you can sense the euphoria, right? You can sense the euphoria across the board, across the sector early this morning. Well, that's the extension of exuberance that we've seen in the previous session. Market capitalization of BSE perhaps at an all-time high too. Metal up and above with gains of 0.6% for metal. Let's talk about realty. Let's talk about auto. Auto is perhaps the only one out. A bit of profit booking sinking in early deals for auto basket. And let's also look at the other sectoral indices. Realty index stacking up well with gains of 0.25%. Top gainers and top losers that we have on the charts right now. Let's have a look at that just to see how they are shaping up. Just to see, look at the mark there, 20,000 level, pretty out there on the screen, right? L&T, where the buyback price or the offer has been revised by the company. ICICI Bank, Hindalco. These are some of the top gainers that we have in early deals. JSW Steel, Tata Steel, and Ultratech Cement. Essentially industrials, metal combined with that of cement. DV's Lab, Power Grid, along with ONGCs are some of the other top gainers that we have on the screen. Let's also look at the losers there just to see how that is stacking up. Adani Ports, HUL, and Adani Enterprises. Essentially, we are looking at Adani group of companies which have witnessed some amount of profit booking in early deals. Nestle India, Britannia, and Maruti Suzuki. Advances 38, declines 11, unchanged remains 1. Market breadth clearly in the favor of advances. Needs to be seen if profit booking creeps in, but also let's get another perspective on board to understand what's the strategy that we can play out for. And to take the discussion forward, we have Sneha Seth, Derivatives Research Analyst at Angel One. Morning there.
Very good morning.
A bit of profit booking finally creeping into Adani group of companies there, and metal names like Tata Steel, JSW Steel, they're stealing the show in early deals. What do you make out of it?
See, Adani Ports, I guess it has been doing decent enough of late, but I think there are many other segments which is doing quite good, and that should be the focus for the time being. So banking index, if we see recently, it was in a congestion zone, and finally it has come out. Although it is still far from the all-time highs, and I really feel that there is a potential in this space to go higher because decent private sector banks have been trading at a decent level. So IndusInd Bank, Kotak Bank for that matter, ICICI, this counters looks good at this point in time.
All right. What's your assessment on the mid-cap stocks? What do you find interesting within the space that you think could serve as a good recommendation to our viewers there?
See, overall mid-cap, yes, we have seen a decent run in mid-cap space. And I think that the momentum should continue in a recent time. Yes, if you see overall in this period of time, we have seen a sharp move there. But I would say that we need to focus in other space as well. Little bit of profit booking is likely to happen there. So one should shift their focus from there to some counters wherein like metals, which has recently shown some strength, banking space, which I've talked about. So that should be the focus for them.
All right, Sneha, we're just going to leave it at that. And thank you for taking out the time early this morning. All right, let's address the stocks and news that we have for you. L&T, like I addressed first, while addressing the top gainers, the company has increased buyback price from 3,000, beg your pardon, from 3,000 rupees to 3,200 per share. Maximum number of equity shares to be bought has been reduced. to now equity holding of 2.2%. If you look at this increase in the announcement comes right after the announcement of BSE where the buyback price was revised. The final buyback offer price was finalized by the buyback committee of the company based on a premium over the daily average of the closing price on BSE and NSE in immediately preceding 2 weeks and the date of the buyback committee meeting. That was held on September 11. So that's the one for you. Look at the sharp uptick that we're looking at the stock. 3.5% clocked in for this one. Reliance Industries, that's another one for you. Well, never fails to surprise there. Reliance Retail is where the news is coming from. KKR is expected to invest in around 2,069 crore in Reliance Retail Ventures at an investment of an equity value of 8.3 lakh crore. So that's the one. KKR's stake with this will increase from 1.17% to 1.42%. Also, I wanted to address in cement stocks. There is a CLSA report there. Actually, there have been few brokerages that have been coming in last couple of sessions, right? There is a CLSA is, typically saying that there is a strength when it comes to the demand for the sector, which is continued for the month of July and August and is helped by relatively drier weather for the last 2 months. Cement demand has increased by low double digit on a high base. Expect the demand momentum to continue, helped by a weaker monsoon. There has been an unseasonal hike for the month of September. Price hike, however, at the same time, to an extent, is partially offset by a sharp jump in the fuel cost. CLSA doesn't see a case for upward revision in the earnings just as yet and also says that the valuations remain elevated. Markets have had a mind of their own for last couple of sessions. You're seeing maximum traction building in for Ultratech Cement. Nifty 50 stock perhaps, which has been doing well, needs to be seen how is that stacking up in today's session. But we're going to be talking more about the fundamental story, what's behind the rally, the fundamental factors that are perhaps driving in the rally for Nifty 50 above and beyond 20,000 level. And to join us to take the discussion forward is Gautam Duggad, who is going to be joining in just a bit. He heads the research and is director at Institutional Equities of Motilal Oswal Financial Services. We're going to be connecting with him in just a jiffy. But before that, look at the run that we're seeing for all the couple of indices right now. Across the board is where we're seeing the traction. Perhaps there is a bit of, most of the brokerages note have come in. Kotak Strategy in the morning has come in. And they spoke about limited point in trying to find fundamental reason behind the steep increase in stock prices of several mid-caps and small-cap stocks. In fact, they've titled their brokerage name as Mad Cap Dash, not Mid Cap Dash. So that's where a bit of, you could see that the euphoria seems to be overplayed, at least for the broader index, when it comes to select brokerage views. It talks about there being no meaningful change in the fundamental of most of the companies. In fact, they have only worsened in many cases, according to Kotak. The primary driver of the rally, according to the brokerage, appears to be irrational exuberance amongst investors, with high return expectation being driven by high return of past few months. So that's where the exuberance is coming in, no fundamental reason. And there has also been a varying degree of exuberance in the mid-cap and the small-cap space. In fact, if you see, most of the traditional favorite mid-cap stocks of institutional investors in the broader consumption sectors have actually been the large laggards in ongoing mid-cap rally, given the weak consumption demand in general. However, the valuations of these companies have stayed higher or have gone to historical high levels due to earning cuts. There is risk of lower profitability, lower valuation multiple due to weakness in the business model and a couple of other factors out there. So essentially, we are looking at a bit of cautions and a divergent trend playing out within the broader caps also. In fact, stock with great purported future but a mediocre history is what they have actually pitched it for. And many of these new favorite mid-cap, small-cap names, these are essentially stocks of institutional and retail investors that are in the broader investment sector, be it in terms of capital goods, defense, EMS, railways, real estate, renewables. These are the ones which have actually managed to surprise a bit on the upside. They have delivered eye-popping returns in the past 3 to 6 months, led by the broader investment narrative. That's where the whole team is coming in for, right? You've also seen that sharp uptick coming in for the defense space, for the capital goods. EMS space is something which we need to talk about, and perhaps we'll be talking to Gautam Duggad of what his assessment is essentially. But look at the divergence of trend and the performance that we've seen even for the broad cap index within that. Large cap index, also the stock with no history or possibly future. The last new favorite mid caps and the small caps stocks have fallen in a dubious category of a turnaround story. Whether it needs to be validated, something perhaps fundamentals, we need to see more of the fundamentals to kind of validate that. But many of these companies have been through serious operational and financial challenges, including the bankruptcy in the recent past. But the market has high hopes of these companies doing well in the future. So that's the word. Look at something like a Suzlon also. The stock is doing extremely well and we know the turnaround story. But let's go back to Gautam Duggad and get his perspective on what's driving the rally, if there's a change in the fundamental and what's beyond the trajectory that we are witnessing. Morning there.
Good morning.
All right. I'd want to understand from you, what are the factors that you're seeing that are driving the markets at a record high level of a 20,000 mark? That is one. Do you see any fundamental changes in the companies, or you think this is just a rally which is exuberance driven with no fundamental data backing it? How are you looking at it?
So first of all, thanks for having me. Good morning.
Pleasure.
I don't think any rally in the market is not backed by fundamentals. This is purely fundamentals driven rally, right? So for example, let me give you a few data points. 2010 to 2020, the corporate earnings, that is the Nifty, they compounded at 6.5% CAGR for 10 years. And in that 10-year period, Nifty gave you 8.5% returns. So broadly in line with the underlying earnings growth. Now, last 3 years, between FY20 to FY23, the Nifty corporate earnings, the Nifty 50, they've compounded at 23%. So if you see the stock market returns in the same period, it is compounded at 27%. So again, tracking the underlying earnings growth. So we had gotten used to subpar earnings growth for such a long period of time that when the earnings growth recovered and market sort of followed it, we are finding it difficult to believe that there can be a good bull run led by fundamental earnings. I'm talking about Nifty large cap. All said and done, there is a lot of hue and cry about 20,000. Ultimately, it's just a number and a small milestone. If you look at the last 5-10-year kind of a return of the market, right? If you look at the last 10-year CAGR of Nifty or even 5-year CAGR, whichever way you want to look at it, you have hardly compounded at 10-12%, or rather 12% on a 10-year basis. As of yesterday's closing, Nifty's 10-year CAGR is 13%, 5-year CAGR is 12%, and last 1 year we have given 12% returns. So this is not some unusual returns which have happened, right? It's just because the number is 20,000 that one is getting carried away. End of the day, percentage compounding returns are very modest, 12-13%, whether 1 year, 5 year, or 10 year. I'm deliberately not taking 3-year number because that was the time when we came out of the COVID bottom. Hence, 3-year CAGR for Nifty is 20%. Now, coming to your second part of the question, specifically in mid caps and small caps, yes, this year has been spectacular. YTD, the small cap and mid cap Nifty index is up 26 to 28%. And some pockets have obviously seen overhitting, but that is always the case in any bull market. Some sectors will extend, beyond their fundamentals, and some sectors will underperform. But again, if you look at the compounding of NSE Midcap 100 index, on a 5-year basis, we have compounded at 17%. If you look at the NSE Small Cap 100 Index, which is a small cap representation, it's compounded at about a measly 12%, same as Nifty. So, whether we are in a euphoria or an exuberance depends on what time frame you look at. If you look at the YTD CY23, obviously you will find that everything is hunky-dory and we have given the best of the returns. And if you look at very select pockets which are up 3x, 4x, some stocks belonging to industrials, defense, railway, they're obviously up a whole lot in the last 12 months. Almost all the real PSU stocks are up 4 to 5x. But that cannot be the barometer to sort of, paint the whole market as a bubble.
That's a fair point made there. But let's talk about the companies with a mediocre history perhaps doing too well, especially the eye-popping numbers that we've seen entirely from the defense, EMS and the capital goods space when it came to the entire broader index rally. Do you see merits in the outperformance that we've seen from the space? Or you think there is going to be some amount of correction perhaps which will creep in on account of fundamentals not exactly matching the valuation that these companies are demanding at the moment?
So look at it this way, why the stocks have gone up. There are two very basic reasons. One is the overall macro environment for some of these sectors has changed materially, and it's changed for the better in the last 3-4 years. The government's whole emphasis on indigenization, Make in India, PLI, the big capex and infra thrust, the big push towards renewables, even in case of defense and power. I mean, those are spaces which exactly 3 years back were totally ignored, right? And why 3 years? If you look at the capex cycle, the last capex cycle ended somewhere about 2012, right? So it's been almost 10, 11 years that you are seeing a resumption of a private capex cycle with a lot of thirst towards infra creation and manufacturing. As a country, we have never focused on manufacturing with so much emphasis that we are currently seeing, right? It's always been a consumption-led economy, which, by the way, is still the case. But yeah, I mean, incrementally over the last 3-4 years, and specifically post-COVID, you've seen the government's whole policy momentum and policy thrust, moving and tilting towards the capex infra manufacturing bit. Second, the starting valuations of some of these companies when the rally began 3 years back was very different than what it is today. I'll give you a simple statistic. If you look at the top 1,000 stocks of India, roughly 103 to 105 are industrial stocks, which includes all your power, defense, cap goods, and all that category, construction, infra. Their combined market cap in July 2020, which was exactly 3 years back, was about 7 lakh crores. Today, their market cap is 23 lakh crores. So clearly, a lot of the distance has been covered as far as valuations are concerned. Valuations are no longer cheap today, they are expensive, vis-a-vis their own historical averages, as well as in absolute terms. But is it all froth? Is it all euphoria and speculation? I would say no. There is also an underlying element of fundamental improvement in their balance sheet, growth, earnings. Obviously, that is the case, which is why we have seen a whole lot of these stocks rallying significantly. Now, if you study the past cycles in market, you will find that in every bull cycle, there are always few sectors which overextend themselves, where the stock prices or market caps will run ahead of the fundamentals. So to answer your specific question on correction, it's anybody's guess when the correction will come, because there is a nice saying in the market, more money has been lost waiting for the correction than in actual correction. So I won't hazard a guess on timing of this correction. I would rather say that wherever you feel that the underlying valuations are not justifying your potential corporate and cash flow growth for the next 2 to 3 years, there's no harm in stepping out of those segments or those pockets. If you're made your money, there's no harm. If you believe that valuations have run ahead of itself, then you sell, right? But these are very long-term cycles which can continue to run for a couple of more years, because this cycle is resumed after a lull of 10 to 12 years when everybody used to wait for when will the private capex cycle happen, when will we get back into manufacturing and infra creation. So it is happening now in front of our eyes. and which is what some of these stocks are also reflecting. Couple of them, as we discussed, some of those spaces are obviously very overheated, and that is where you should sort of step aside.
Gautam, I'm just going to have a follow-up, on that one. Which sectors do you think have overextended themselves in this rally? And which
I
are the...
would think...
Go ahead.
Sorry, complete your question.
No, please go ahead.
No, so just to carry forward the thought from the earlier question, industrials clearly seem to be a space. EMS, defense, power, some of those sectors have obviously seen a huge rally, YTD CY23. So can there be a potential 15-20% correction at some point of time? The answer is yes. But when that correction will happen is anybody's guess. They can correct after rising another 30%, or they can correct even from the current prices. So that's one of the dilemma that every investor will face. The answer to that lies in your time horizon. If as an investor, your time horizon is longer, then you don't need to worry about it. But if your time horizon is very short, say 6 months, 12 months, then you need to take that call on risk reward, where the risk reward is favorable, unfavorable. So industrials, capex is one space where clearly the positioning is looking quite, I would say, optimistic, and underlying risk reward has turned significantly unattractive now.
Where is the risk reward attractive according to you? Which are the space which still seem to be undervalued?
So I wouldn't call it undervalued, but risk reward is very attractive in financials, especially large cap banks, whether PSU or private. The valuations have corrected a whole lot in the last 3-4 years because the underlying market cap has not kept pace with the underlying earnings growth. So stocks which used to trade at 4 times, 3 times, 2.5 times price to book are now trading at 40-35% lower price to book multiples. Second, large cap IT to me looks quite attractive. Since last 3 months, we've been talking about it. That large cap IT at some point of time, once the commentary changes, maybe in 2H FY24 or beyond that, risk reward is very attractive for large cap IT in my view, because the valuations have corrected. Do remember that in CY22, NSE IT index was down 28%. While the market is at a new high, large cap IT stocks are still down anywhere between 20-30% from their December 21 highs. For example, Infosys, if I remember well, was a 1,900 rupee stock 2 years back, right? So what was trading at 30 times that point of time is now available at 21, 22. Now, obviously, it is also not screamingly cheap, but we are talking about a relative valuation in this market, which is at a new high. Plus, I think the fundamentals of the IT sector should turn around within a couple of quarters. So that is one space where I think there is a better risk reward. And third, I would still think that for those with a long-term orientation, the discretionary consumption sector still offers tremendous growth opportunity. And lastly, auto, where the cycle is turned after 5 years and valuations are still quite reasonable, especially in the large cap. So those are 3-4 pockets where I think you still have enough risk reward opportunities from a slightly longer term perspective.
Gautam, could you speak more about the discretionary space, where exactly the traction lies? That's part A to the question. And part B is a bit of NIM compression was witnessed in the financials in Q1 for the large private banks, in the entire space, so to say. Would you prefer an NBFC over banks?
Yes, we actually have been preferring NBFC over banks since April, when the RBI first paused in its monetary policy tightening, right? So that is when we shifted the allocation within our model portfolio away from banks towards NBFCs. You rightly said, NIM compression is going on, and we saw a glimpse of that already in 1Q. Possibly there might be some more compression to go in the subsequent quarters. But we are talking about a risk-reward equation which is very favorable for large cap banks. Even after compounding earnings at a very rapid pace between FY18 to 23, when earnings went up 5 times for the BFSI segment of the Nifty basket, we are still talking about a 20% growth for FY24. Now, obviously, this will not be a linear growth. First quarter, we have seen 35% growth, and this growth will taper off and moderate every subsequent quarter. But your valuations, something like ICICI Bank, HDFC Bank, even Kotak for that matter, SBI, Bank of Baroda, IndusInd Bank, all the large caps, private and PSU, they are looking quite attractive from a valuation perspective. Obviously, NBFC from both growth and valuation perspective. So our bias is more tilted towards NBFC at the moment, and then banks. And within banks, we are significantly overweight on PSU banks versus private banks.
I'd want to understand the current stance of Motilal Oswal Insti on the current market situations. If they're looking at more perhaps bullishness coming in for the markets, FIIs have been selling, right? If you see the sell-offs that we've seen, they've sold off around $800 million of equities in the last 4 sessions alone. Do you find the valuation of Nifty a bit expensive? Just an aerial view before we leave.
No, actually, on the contrary, I won't look at 3-4 days data to derive any conclusion because it will be a noise. You look at the YTD data, even if you want to look at the short-term data. So CY23 FIs have bought $20 billion. Essentially, they have reinvested the money that they've taken out between October 21 to February 23. Whatever they sold, that was around $17 billion. Now they have reinvested that money, right? Second, as far as domestics are concerned, you are seeing continuous inflow. Yesterday's data on SIP is suggesting we are almost closer to 16,000 crore per month SIP number now. As far as valuations of Nifty are concerned, they are somewhere about 18.5 to 19 1-year forward PE band on FY25, which we will start discounting in another month or so. So Nifty valuations are reasonably okay. The real premium versus Nifty or even to its own historical averages is in NSE mid-cap index. The mid-caps are clearly expensive versus its own averages as well as versus Nifty. It is currently trading at about 18 to 20% premium to Nifty. So either the NSE mid-cap index has to sort of spend some time in a range, time correct, or there should be some 10-15% price correction so as to make the valuation and risk-reward equation slightly more favorable. Just one more point, you spoke about bullishness. We are now entering a period of election cycle, right? In a couple of weeks, you will see announcement for state elections, and then that will build the momentum and crescendo for 2024 Lok Sabha elections. If you look at the last 25 years of data, 5 Lok Sabha elections, 1999 till 2019, you will find that 6 months before the election results are announced, that is between November to May, Nifty has always given positive returns, ranging from 9 to 10% to 32%. So whether the history will repeat itself, we'll have to find out. But the history and precedence 6 months into the election result announcement is quite favorable for the markets.
Last 30 seconds, what's next for Nifty? 20,000 level now. What levels are you looking at now? Are you looking more bullishness coming in for the markets? What's the next milestone for you?
I honestly, Nickey, don't look at individual Nifty levels.
Sure. Just for the benefit of viewers out there, maybe the levels perhaps just to see the direction in which you think perhaps the market would be heading.
So let me explain it mathematically. FY25, our EPS is 1140 rupees, right? If we were to give 20 times 1 year forward to Nifty 1 year later, which is what currently it is trading at for FY24, let's assume that the same multiples continue for FY25 1 year down the line, then you are basically talking about somewhere about 22,500 to 23,000 kind of a fundamental level for Nifty. But this is purely based on fundamentals. I'm not a person who tracks levels very closely because that's, I think, a domain of a technical analyst.
All right, Gautam, we're just going to leave it at that. And thank you for taking out the time this morning to speak to us. All right, with this, it's a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.